Hey everyone, welcome back. We are here to talk more about covered calls. I love the covered call. It is absolutely where I think that options traders should start because it's just so impactful. We're going to get more into my rate of return here and just discuss how I've been able to get this and the trades that go into this. Okay, so this is my rate of return from February 20th to February 19th, 2024 to 2025. It was 105%. A lot of people want to know what kind of strategies get me this rate of return and how I do it. And this is how I do it, is we start with the covered call, okay? So in this video, I'm going to show you the best ways to trade covered calls that make me about 40K per month or more consistently without taking on extra risk, okay? If you've struggled with small returns or inconsistent profits from covered calls, my 3-step process that I'm about to show you will help you increase your returns a lot. So let's get into it. So here are challenges with traditional covered calls. Like if you read a textbook or you've just learned off of somebody off of YouTube who read a textbook and is then explaining to you how the covered call works. These are some common problems that people have with them. And the good news is they're all completely avoidable in most cases, okay? So the first one is low premiums. So a lot of people sell covered calls for low premiums, and this conservative selling leaves money on the table that they could have otherwise gotten. You can grow fast with covered calls. It doesn't have to be a slow growth, okay? Early assignment of shares. So a lot of times people might sell covered calls and then lose their shares and miss out on potential capital gains. This is also avoidable most of the time. Not all of the time, but most of the time. And then the last one is lack of adjustments. Some traders out there don't know how to adjust the call that they sold, the covered call that they sold with rollouts to properly maximize profits and bring their cost basis down on those shares that they own. But I have some tricks of the trade, or tricks of my trades, that I am going to share with you in the next couple pages. So this is more about my system. Okay, so one thing I love are systems, and I have systems inside of my systems. Why? Because this really helps me take the emotion out of trading. And when I first started trading, that was really a big deal. Like, I was an emotional trader, and I've learned through systems and having them that it all just ends up that I'm following a playbook now. I don't even have to bring any emotion into it. So I'm hoping to give you guys this gift too by these video series. So let's talk about my 3-step covered call system. It's really gonna boil down to 3 things here. The first one is picking the right stocks. So we are gonna focus on stocks with strong fundamentals to mitigate risk. What I'm saying here, by being all fancy, stock speak here, is that we're going to try to buy stocks that don't tank right away on us. Okay, so that's what the goal is here. We want stocks that are going up. The next thing is that we want to use covered call variations. So again, if you are just reading an options textbook or taking one of those classes that might be on your broker's website, they're going to show you how to trade one variation of a covered call. But believe me, there are so many. There are 5 that I love. There are more than that in the world, probably that I don't know about. But the variations are very important. Knowing variation and knowing strategy, which is really what a variation is, it's strategy, can really help you amplify the amount of premiums that you can bring into your account and help you grow that account faster or pay for things in your life, which is another goal of yours, I'm sure. And then the last thing is properly manage rollouts. So there are opportunities to roll out that can get you more premium coming into your account, that can allow you to sell when you want to sell, allow you to not sell when you don't want to sell. This comes with experience, but it's important to know how to manage them and to get a starting point somewhere. Okay, so picking the right stocks is a lot like if you were going to want to buy a property, right? Either a retail property or a rental property. If you're buying a retail property, you'd have 2 choices, right? You could buy one that was on a street nobody goes down, and then that property would probably be inexpensive, but it would sort of not get you very much in rent. The returns wouldn't be so great. Same thing with just buying a house in a bad neighborhood. The returns wouldn't be so good on that house. So it would be a much better decision to buy a well-maintained property in a prime location in either one of those situations, whether it was a retail location or a home location. So if we're serious about making long-term money and we're going to be options traders and stick in here for the long term and really take our money seriously, what property are we going to choose? We're going to choose the better property, okay? So the same thing is true with stock picks. We need to pick stocks the same exact way. So weak stocks are exactly like bad properties. You're making inconsistent returns and you're dealing with massive risks because you don't know if you'll be able to rent that property out. You don't know if that rundown property is going to need a lot of repairs and create a lot of expense for you. Where if you get something that is better, it's just going to probably go up in value and you're going to get increasing rents coming to you, okay? So strong stocks are exactly like prime real estate. They steadily increase in value over time. They attract more to the stock, and we need that as option sellers and options traders. We need other people to come in and buy our contracts for us, and they're going to do that in volume on the great stocks. They're not going to come in volume for the lower stocks, so we can create for the bad stocks, so we can create more premium coming into our account when we trade only with the best stocks. They also are going to give us consistent returns month after month. So these are some of the reasons why picking the right stocks is so important. I'm going to go into a 5-point explanation as to what I use to find the best stocks. So to make a great stock pick for options trading, we have to focus in on 5 things, in my opinion, okay? And the first is that the stock has strong fundamentals. Fundamentals sound really complex, but they're not. They're really easy to research, especially on Yahoo Finance. I love Yahoo Finance. So you go to yahoofinance.com, you enter your ticker symbol in the little search bar, and then on the left-hand side of the screen, there's like these rows of information. One of them is financials. So you click on the financials, and then you just look at the financials for the last 4 years. It's usually automatically what comes up there, so you don't even have to click an extra button. And now you have to ask yourself, is the earnings and revenue for that stock increasing every year for the last 4 years? Does the company generate consistent revenue and profit margins? Is the company reinvesting its profits and growing without taking on excessive debt? This can all be found by just looking at the stock's financials there on Yahoo Finance. And it doesn't take that much to look it up. It's just kind of incredible. I've made my stock picks for options trading just off of looking at the information on Yahoo Finance within 3 minutes of time period. So like if the stock doesn't have strong financials, I'll tell you why this matters. It means that the company is struggling to grow and it's making it riskier for long-term trades. And a lot of our trades as options traders, to be successful, they're going to be longer term. We're going to have to go into longer term trades if we want to be really successful, because we're going to want to have time being on our side. And time in options trading is called theta. You will learn that maybe later if you don't already know it. When we have revenue instability, it leads to stock volatility. And we need like the stock to do well again with revenue before that stock can recover from the volatility of a sell-off if their earnings and revenue are bad for a quarter or two. That's not a position we want to find ourselves in, because it's very difficult to options trade from a position of being underwater. So we want to try to avoid going underwater very often, if at all, okay? And then the other thing with the debt situation here is that higher debt means that the company is more at risk during an economic downturn. So economic downturns can happen, but when they do, you want to be in the stocks that are going to hurt less badly when that happens, okay? So this is a risk mitigation strategy for the future. So remember to focus on those strong fundamentals. You do not want to work with a stock when you're options trading that has declining earnings and revenue, on a per quarter basis or even year over year basis, that's a red flag to stay away from that one, because there's just so many stocks out there that have great, strong fundamentals that it's really, my opinion, that I wouldn't want to mess with any that don't. My second point that I will look for when I am researching a stock to buy or options trade with is that I am looking for institutional buying. Okay, so institutions are entities that determine stock prices. They just do. Retail investors do not matter. Our opinions about what companies are good or bad do not matter. The only people that can determine what stock prices are doing are institutions. So I look for at least 70% of the shares being held by institutional investors. Again, this is something that you can find on Yahoo Finance, or just doing a Google search on that stock. You will maybe be able to find that really quick there as well. But institutions and hedge funds and pension funds have access to insider level research, advanced analytics, and long-term investment strategies that some of these ETFs are in as well. And if they are buying and holding a stock, it's because they have confidence in that company's growth and stability. Okay, so one of the things that I do is I just follow what they do. They have so much more insight than I do, and I just sort of like resign myself to the fact that they're probably smarter than me, and they probably are spending a lot more time researching this than I am. They also tend to really stick with quality. When we talked about those strong fundamentals earlier, you have to understand they've done the research on the fundamentals. They are the reason that they are involved in those stocks to begin with is because they've done the fundamental research and have decided that they like the fundamentals of the company. And believe me when I say they don't skimp on that information. They don't look past that information. They stick with that information and they use it as a part of their playbook, okay? So why this matters again is if institutions aren't investing, it's a red flag to me that the company lacks long-term potential. And when I start options trading a stock, it's a big deal for me. I'm going to be trading that stock not just for a month. I'm going to be trading it for probably 3 to 6 months at the minimum, and I'm hoping 2 to 3 or 4 or 5 years, maybe 10 years, okay? So that's one of the things about this is that you're not probably choosing a stock because you want to do one trade on it. Like that wouldn't make sense to me as an options trader. I would only want to trade a minimal amount of stocks because it will really help my rate of success. So without institutional money, stock prices are also more volatile and harder to predict. So it's not like we need to know and be able to predict where a stock is moving all the time. That's not the point here. What is the point is that if the institutions are heavily involved in that stock, they have more of an interest in keeping that stock price up or in a range, and they will fight to kind of keep that stability there in that stock by buying more shares or selling when the stock gets an all-time high. But they will keep the stock sort of in a comfortable range most of the time, okay? And you'll know if they're not because some bad news will come out about the company, and then you'll see institutions leaving. So we can follow institutions and they can do most of the work for us. So the overall thing that I want to say here, though, is that covered calls work best on stocks that have volatility, but a stable amount of volatility, and that they are stocks that are high in demand with the institutions, because the institutions can be like our canary in a coal mine and give us the playbook for how to trade that stock. The third thing that I'm always looking for is a consistent uptrend in a stock. Okay, so this is actually rule number 1. But I thought I'd take you guys a little out of order today to not sound so repetitive. But consistent uptrend, so important. You guys have probably heard me say this a million times, but that stock better be in have a rising 5-year, 1-year, and 3-month chart before I get involved in it. Okay, so if it doesn't meet any of those metrics, if the 5 years down, no go. If the 1 year's down, no go. If 3-month is down, no, I'm not getting involved with that stock. Those all have to be up. Okay, so this is something that I require before I buy shares to sell covered calls on. So here's why I'm avoiding downtrending stocks, okay? Like this could be obvious to somebody who's sold covered calls before, but it's amazing how many people this hasn't occurred to, so it bears explaining, okay? So if I buy a stock and that stock is falling right now on the 5-year, 1-year, or 3-month chart, there's a good chance it's going to continue to fall. And if any bad news comes out about that company, it's going to fall really fast. I know this from experience. I've witnessed so many stocks over the years and looked at their patterns, and this is just the pattern that happens with them. So I've learned this, okay? Anytime a stock falls, that means that my covered calls generate smaller premiums, sometimes no premiums, because it doesn't even make sense to sell a covered call on them. I'm sure you've been in that position if you are an experienced covered call writer. Okay, so selling calls on falling stocks traps me in a losing position where I might need to roll or close at a loss, which I don't want to do. And I might even have to sell my shares for a loss, which again, I don't want to do. I want to do that as minimally as possible. I am not going to say that that has never happened to me. It definitely has. It will happen to everyone. But I am telling you, by taking these 5 steps and using them, it will happen less frequently, which will be such a good thing for your options trading career, okay? And then the last thing is that a strong uptrend means that I can collect higher premiums, okay? So anytime the stock is going up, the premiums are getting better over time. I also benefit from stock appreciation, and I don't get stuck bag holding. I don't get stuck with an underperforming asset. I have done my homework here by making sure the 5-year, 1-year, and 3-month charts are going up. That is telling me that we're going to circle back to the last point, that the institutions are buying that stock and they're even more interested in that stock now than they were a year ago or 5 years ago. That's what that tells me. Isn't that cool? We have one slide to represent step 4 and 5 for making great stock picks, and that is that we have a goal of buying monopolies, companies that are monopolies, and if we can't, for one reason or another, we buy industry dominators. Okay, so why is this important? Obviously, you want to own the best. This is a lot like the real estate thing, right? Like, you want to buy the best condo in the best building. You want to buy the best house on the best street if you can afford it, okay? So I realize that there are some times that we can't afford certain stocks to options trade with, okay? Because the best companies, guys, this sucks, are usually really expensive as stocks go, okay? What I want you to understand here, though, is that good things are expensive. And unfortunately, that is true in the stock market as too, because we would love to just be able to buy shares of Amazon at $5 a share. The thing is we can't, because Amazon is too valuable as a company. So the best stocks are expensive. The best stocks are expensive. We just have to get comfortable with that fact. So if we can afford to buy monopolies, we need to, because the thing is that monopolies have a dominance where they are very, very hard to compete with. They've already done the work of becoming so dominant within that field that they now own a monopoly. So it's very difficult for a new company to come in and compete with a monopoly and undertake them. It's just very difficult. It's more likely that the monopoly would buy up the small competitor than it would be that the small competitor knocks over the monopoly. That's just the way things are. That's business. So you can sort of sit there and be a little bit like, that's not fair, or that kind of stinks. Or you can just get on the side of the monopolies and profit alongside of them. That is what I do. So that is one of the things that is my secret to my success. So if I cannot afford monopolies for some reason, like for example, right now, probably the best big like wholesale place that you can buy from is Costco, and they have a monopoly pretty much. I mean, Sam's Club is a close second, but I think we all agree that Costco is probably better than Sam's Club. So if we cannot buy those monopolies, because right now Costco is $1,000 a share, that's very expensive to options trade with, we want to go and look at industry dominators. Okay, so what would be an industry dominator? If there is a athleisure company that is the industry dominator, you're going to want to buy that versus the one that's sort of a known name. but it's not the best. So immediately my brain kind of goes straight towards an example of fast, casual Mexican food of Chipotle, right? I think we agree they are the industry dominators. They don't really have a monopoly because there are other fast food or fast casual restaurants that you can eat at. But within the Mexican food chain sort of situation, they're the industry dominator, and that kind of can't be argued with. So, that's an industry dominator. That's an example of one. I think you see my point here, but you want to buy the best companies whenever you can. I would even say that if I can't find a best company, I'm just not buying anything. All right, we wrapped up what we had to say about making great stock picks in our 5-point system. So now we are going to step 2 of how we do really great with being covered call writers, okay? So step 2 is that we have to have and employ covered call variations and strategies, okay? So most covered call writers sell covered calls in one way. They buy 100 shares of a stock, they sell a call at a set strike price, and they collect whatever premium is available. And they just do it that way. And that's it. No strategy, no optimization, just a basic trade, okay? That is not how I made 400K trading last year. That is just not how I did it. I did more homework than that. And you can too. It's fairly easy to do this, okay? So if you want to generate consistent income while keeping control of your shares, you need to adapt a covered call strategy to market conditions and use variations that extract the maximum amount of value from every trade and from your capital. I rotate between 4 to 5 different covered calls, variations, and strategies depending on market conditions, my stock's movement and the volatility in it, and how much risk I want to take on. Okay, so this allows me to collect more premium, keep control over my stocks, and avoid costly assignment mistakes. All right, so when we get over to the next slide, we're going to talk about the 4 variations that I do. My favorite covered call strategy is the fast money trade. This allows me to grab the highest premium available to me while ensuring still some cap gains here, okay? So when do I use this? I use this when implied volatility is high, meaning that options premiums are inflated in value, and I get paid in inflated value. When I want to quickly capture cash flow instead of holding onto stock for long periods of time. When I'm okay with my shares being called away for a profit. So if you want to know how I made 400K last year, what you do need to understand is that I had no emotional attachment to many of my shares. I was just super fine and even intended for a lot of my shares to be called away in a rinse and repeat way. So this is my go-to strategy when I want to maximize premium income right now while also ensuring capital gains. Most traders sell their covered calls at strikes that are too far out of the money to really capture like a huge amount of premium. So they're collecting tiny amounts of premiums and they're thinking that this is a safe strategy. There is a problem with that strategy though, and it's that they are actually putting more risk into their portfolio because they are not bringing the cost basis of their shares down. They're also not maximizing cash flow or maximizing the capital that's in their account. So for me, with the fast money trade, I pick a strike price that gives me a strong premium payout. I get a little bit of a cap gain if my shares are assigned, and it's the optimal balance between risk and return. Okay, so the key here is to be able to understand options pricing. So if implied volatility is high and I'm selling it at an optimal time, that means I'm getting paid a lot more, but I'm not taking on any more risk. I'm actually reducing my risk because I'm reducing my cost basis. This trade works well when I'm holding stocks that I don't mind selling at a higher price, but it also ensures that I'm maximizing my earnings on every covered call that I sell with this strategy. Traders who focus too much on avoiding assignment and getting their shares called away miss out on this huge cash flow advantage, which is why this gives this trade such an edge. Okay, earnings trades are another one of my favorite trades. And it's an area where people have heard something like, oh, trading earnings is so risky, you should never do it. And it's something they repeat without thinking about the real data behind this trade and what you can do with selling around earnings and why it's so lucrative. So when we sell calls around earnings, we can collect massive premiums. Okay. So when to use this trade? Before earnings reports, when implied volatility is very high, and implied volatility is uber high 1 to 2 days before earnings, it starts getting higher 2 weeks going into earnings and incrementally increases as we're getting closer and closer to earnings. So when I do this trade is when I want to collect a massive amount of premiums without putting in any additional risk, when I'm okay with potential assignment, but getting still a really big payout. So earnings is just such an amazing time to sell covered calls because I'm collecting premium on implied volatility when it's sky high. Someone is paying me for volatility, implied volatility, which I love. I will take money for people paying me for implied volatility any day of the week. I wish earnings happened more often. Okay, so what I'm saying to you right now is that option premiums are really at their peak the days before earnings. So why aren't we taking advantage of that? I am. So here's how I exploit high implied volatility to collect bigger premiums. So the step one is that I look for stocks with high IV leading into earnings. So there are stocks that just really get pumped up closer to earnings. Stocks that come to mind are sort of like an Nvidia or an Amazon, things like that. They have naturally high premiums, but they get even higher as we're going into earnings. Step two, I sell up near the money covered call 1 to 2 days before the earnings release date. Okay. Sometimes I'll even sell it an hour before the earnings call at the end of the day, and then the premiums are just unbelievably high. And then step three is that I wait for earnings to happen, and the next day it's either I know that the shares are going to be called away from me, which I don't care about because I got paid for all that implied volatility, or there's such an implied volatility crush the next day if the stock drops that I got paid all of this implied volatility, the implied volatility crush is gone from that contract, and I can quickly close out that contract and just take in most of the premium. It's really quite a beautiful thing. So what makes this strategy so powerful? You collect way higher premiums than normal trading days. Implied volatility drops after earnings, causing the call to a lot of times expire worthless when the stock price drops. And meaning that I keep all the money from the trade, okay? And if my stock gets called away because the stock takes off, I'll get some cap gains and I'll get all the money from the trade. So even if the stock jumps, I make a really strong return. So this is a way that I trade earnings where I win either way, and I absolutely love this trade. Okay, so there are some of you that want to keep your shares, and I don't blame you. It's a good idea to keep a lot of your shares, okay? So I've just talked about how I don't mind my shares being called away for the last two strategies, and I am also here to tell you that I like to keep some of my shares too. So you're wondering, what? You're talking out of two sides of your face, and I absolutely am. One of the things that I do is I trade a very limited amount of stocks. So while I'm trading covered calls, I'm not trading covered calls on one lot of shares. I'm trading them on sort of like 7 lots of shares. So I can have multiple strategies going on in my account on the same stock in multiple ways. Do you see that? Okay, so some of these shares I'm going to be doing the get paid, going up strategy. And my goal here is to keep the shares over an extended period of time and see how much cap gains I can make while I'm also collecting premium, okay? So when to use this trade? When do I use it? When I want to stay in the stock long term, but still collect consistent cash flow. When I believe the stock will gradually rise out of time without huge volatility. So there are stocks that are better for this, okay? Like an Nvidia that goes all over the place isn't going to work as well for this in many instances, but sort of like a slower grower that's really solid, like maybe a Walmart would, okay? Also, when I want to sell far out of the money covered calls without losing the shares. So that's why I'm doing this. So a lot of traders think that selling covered calls means you have to accept assignment and give up your shares. And that's false. Like, you don't have to. I use the get paid to going up while going up strategy to keep my stocks while still collecting premium, like every month, every 2 weeks, maybe every 2 months. It just depends. But here's how I do it. The first step is that I identify a stock with a strong long-term growth potential. You guys already know that's part of my strategy. And perhaps it grows slower. It's just a slower grower. I'm not looking for something that's trying to make 100% return here per year. I'm looking for something that's making a solid 15 to 20% a year on a good year, okay? Step 2 is that I sell a covered call that's far out of the money, and maybe for a longer period date and time to make it worth it to sell the call. And the step 3 is that I collect the premium, but I maintain ownership of the shares, since the strike price is much higher than the market price. Okay. This strategy allows me to keep collecting passive income without losing my shares. I benefit from the stock's long-term growth while making extra cash. A lot of people liken this to a dividend. Like, the amount that you make here is better than a dividend for sure, but it's similar to a dividend. Like, you're getting paid maybe once every 3 months, once a month, something like that. Okay. And then I sell covered calls here without being too worried about assignment. Okay. Most traders don't use this approach because they just think, or most shareholders, I should even say, don't use this approach because they think covered calls equals selling your shares. And it doesn't. You will have to know, though, in order to do this strategy effectively, how to roll out and how to roll in. So that is going to be the last thing that we're going to talk about in this video series today. But this strategy allows me to just keep stacking premiums and making extra dividends on stocks that I'm holding for the long term. Our fourth covered call strategy is going to be the volatility trade. Okay, this one is very fun. It does require more patience than the others, okay? And it requires you to watch the market a little bit more, okay? But you can do this in sort of an automated way with some tech that I would introduce you to in my program if you were interested in learning how to do this with me. So what we're doing here is we're buying shares on dips, and then we sell calls when the price recovers. So when do we use this? When a stock's price is temporarily oversold and there's a downtrend or market dip, okay? The second time I use it was when I expect a stock to rebound within the covered call's expiration. So a rollout strategy is something that you can use here as well. And then when I want to double dip some profits by making money on the stock recovery and the options premium. So there's like a huge potential with this trade, because what you're doing is you're buying stocks when they're low on the dip. You're waiting for the stock to rise maybe $5 a share. Then you're selling a call from there, which really gets you excellent premiums, and it gets you a ton of cap gains. And it's just absolutely lovely when it works out, okay? And it usually works out, okay? So this is one of the most underrated ways to trade covered calls, and I never see anybody doing this. And I'm just like, why aren't you guys taking advantage of the volatility that is in that stock? That is what it's there for, is for us to make money as options trader. As options traders, excuse me. So here's how this trade works. The first step is that I wait for a stock to dip. Like, I am literally just waiting sometimes for a dip. This also makes it very, those down days seem fun. Like, if you ever feared down days before, when you're volatility trading covered calls, you're like, I can't wait for a dip because then I'm going to pounce, okay? So I wait for a pullback or when the stock gets oversold, and then I buy the shares at a discount. I'm buying them on sale, okay? Step 3 is that then once the stock rebounds to like a target price that I'm looking for, like say that stock was trading at 220, I'm looking for a dip down to 215, I buy at 215, then I'm just waiting for that stock to retrace to the 220, and then I sell a covered call that might be like the fast money covered call, and I sell for a higher strike price right there and then, okay? So again, I'm being patient. I'm waiting for the stock to drop. I'm waiting for it to rise, and then I'm selling a covered call. So what are the benefits and what does this accomplish? I lock in a great purchase price for the stock, right? I sell the call when the stock is already moving up, meaning the premiums are higher, right? And then the third thing is if my shares get assigned, I make money on cap gains, on that stock appreciation, and premium. So this is like a double whammy of money coming into your account, which makes us all happy. So traders who sell covered calls too early during the market dip are leaving a ton of money on the table. Do you see that? So I just avoid that. I try to be patient. Time is my friend. It's always my friend. I'm just always waiting for time to pass for the most opportune moment. And I don't get too anxious. I don't get too greedy. I don't act too quickly. So I do see this mistake all the time where people panic when a stock drops immediately and then sell a covered call at a lower strike because they just get nervous. They see their money in the market and that it went down in value and they kind of freak out. So like I avoid that. Again, I have control over my emotions and instead I wait for the stock to recover and I sell a call at a much higher premium, which means that I will make way more than your average trader here because I am just employing this volatility trade strategy. We are on to step 3 of this system of managing covered calls to do better than your average trader, okay? So step 3 is that we need to know how to do rollouts and we need to know how to manage our rollouts, okay? So why do rollouts matter? The biggest mistake I see traders make with covered calls is allowing their shares to be like assigned too early at weird moments. Like you need to know how to roll out and when to roll out. They treat assignment like it's inevitable, instead of managing a trade properly to maximize profits and bring their cost basis down on their shares, okay? So instead of getting forced out of the trade by selling a covered call and having those shares called away from me, this allows me to extend the trade so I stay in control and I collect more income. I'm also able to stack additional premium, and rolling turns a single trade into a multi-layered profit machine, okay? And then I'm avoiding forced exits. Keeping my shares means that I keep continuing to earn without taking on any unnecessary risk. If I allowed my shares to get called away, I may be in the position where I want to buy them back to get into like another covered call. But rolling out allows me to keep the same cost basis and continue to keep that cost basis getting lower and lower and lower. Keeping a hold of those shares, potentially collecting dividends at the same time. And so like my risk profile just becomes far lower when I know how to use a rollout, okay? So let's talk about extending our trades with rolling out, okay? So one common mistake that I see is traders panic when they sell a covered call and the call is in the money and they let their shares get assigned. And this is a huge mistake, especially if you're trading something like that's $220 a share, the call goes in the money for $222, and then they let their shares get assigned. I probably wouldn't do that. I would wait until very close to the trade being at expiration, and I would roll out and up from there. Because this helps me bring down my cost basis on the shares. And I don't want to get in a position where I want to keep trading that stock but have to buy new shares at a higher price. Like that's an avoidable thing, and if it makes sense to avoid that, I will, okay? So I will just roll up in strike price and out in time and continue to collect premium on the shares that I own to bring my cost basis down. So here's how I do it. Here's how I identify when a rollout is needed. If my stock price is close to or above the strike price before expiration, pretty close to expiration is what I'm looking for, okay? So I wouldn't like think about rolling something out that's like midway between a call option. I would wait until I'm closer to the end of the contract because then I'm not buying back theta from that contract. If my call still has a lot of extrinsic value left, I'm also going to think about rolling out. And if the market is moving fast and I want to capture more upside in the stock's cap gains, if I get called away, I'm going to do that too. I'm going to use that opportunity to roll out. Step 2 is that I'm going to close the current covered call for like a smaller debit out of the account. And then I'm going to look at the options chain and sell a new covered call for a later expiration date for the same strike price or higher, okay? And I'm going to collect more premium as I'm doing this. Now, I know a lot of you are sort of going like, this is complicated though. And it is complicated. If you have any experience with rollouts, the only thing that I can tell you is the only way that you get even better and better at rollouts is to continue to roll out. And also pretend that you need to roll out when you don't, to see what your options are. Because you sometimes can get stuck where you cannot roll out. Okay, it doesn't make financial sense to roll out. And you will only get good at this as to figuring out when it's a good idea or a bad idea to roll out from experience. So there's no shortcut here. So what I have actually done with managing my rollouts is I put in the time. I've put in the time to consider rolling out when I think I need to and when I think I don't need to, just to get a feel for how difficult it would be or how beneficial it would be to roll out the stock at that point in time. So I practice rollouts even when I don't have to do them. So I know that sounds odd to some people, but that's actually how I've become, how I've come to get so good at rollouts. Okay, so really the key to knowing what to do with a rollout is weighing how much it benefits you to collect more premium for how long your cash is tied up for. That's really the secret to all of this, okay? So let's think about collecting more premium and just use an example here. And this will help us understand whether this trade is worth it or not, whether it's worth it to roll out or not. So anytime we have the ability to collect more premium and it doesn't lock up our capital and our shares for too long, that seems to be a good reason to roll out to me. So here's an example. If I sell a covered call for $500 in premium at a strike price of $200 expiring in 30 days, and after 20 days, the stock moves to $199, meaning that I'm at risk of assignment, instead of letting my shares go, I might roll the contract another 30 days and I could potentially collect another $400 in premium. That seems like a good idea to me. If those are the numbers, that's great because I just turned a $500 premium trade into a $900 premium trade without additional risk and I lowered my cost basis. Okay, that's something that really could happen in a highly volatile stock or a medium volatility stock, okay? It's probably not very likely to happen in a stock that doesn't have that much volatility. That's why I am suggesting that you need to pretend that you're rolling out when you don't actually need to, because you'll start to get a feel for the actual volatility in your stock and if trades like this exist for that stock and when they do, okay? So if a stock keeps climbing, I can keep kind of rolling and stacking premium indefinitely, and this compounds my returns over time, and you can do this with rollouts. It can really create just a constant income stream. Like, I make so much money on rollouts, it's ridiculous. And rollouts are also roll-ins. That's the other funny thing about this stock trading lingo. So like in this example, what happens if I don't roll? My shares will get called away potentially, and if I want to keep trading covered calls on this stock, I have to rebuy the stock potentially at a higher price to keep trading covered calls. So I miss out on compounding my gains over multiple months of time, and I lose an opportunity to stack cash on the same position, okay? So I think in this way of rolling covered calls like dividend reinvestment in a lot of ways, okay? So instead of cashing out early, I keep my capital working and I maximize my long-term profits, okay? We're gonna go to one last page on rollouts and then we're gonna be able to wrap up this video. So you're almost at the end. Okay, with rollouts and with covered calls in general and having your shares called away and wanting to roll out and then finding out that you can't because there's just no way to make it make sense, okay? That happens to everyone. When that happens, you've got to be graceful about it. Your mindset really matters when you are a trader. It just does. So when my calls go in the money and my shares are called away, this rarely bothers me. Why? Okay? Stocks rarely take off and never pull back. Okay, so I gracefully allow for shares to be called when I cannot roll out into a time frame that makes sense. Okay, so in my example of when I'm allowing gracefully for my shares to be called away, like at that higher strike price, then I can't roll out. Well, what am I doing? I'm actually setting myself up for another covered call strategy, aren't I? I'm waiting for that covered call strategy that I talked about with a volatility trade. I'm waiting for now that stock to drop so I can go back in, maybe potentially buy it on sale, and then do that volatility trade. So I use all of these trades in sort of like a rinse and repeat system to just constantly have something going on in my account and have another way to make money. Okay. Now I'm going to talk about how time frames don't make sense with rollouts sometimes. So I see this, it happens all the time in my mentorship program. There's somebody who will come into this situation. In fact, if you haven't come into this situation, I just don't think that you're experienced with covered calls anyway, because I think this is something that we're all going to run into at some point in time. And the thing is some people will make this mistake multiple times. And that's what I hate to see happen. I don't want to see you make this mistake any more than once, and everyone will make it one time, but I'm here to stop you from doing it a second time. Okay. Don't roll out when the time frame doesn't make sense. And time frames with a rollout doesn't make sense. Like if you have to roll out a call to keep shares for like 6 months in time, that doesn't make sense to me. And it shouldn't make sense to you, because you should have other ways to use that capital coming back into your account that make more sense right now. Capital should be important to you. Cash is a position. You should be able to recognize that there are other trading opportunities that are right around the corner for you to take advantage of. And tying up your cash because you don't want to be graceful about not being able to roll out or get your shares called away and just enjoy that cash coming back into your account, because there's a better way to trade that probably 3 days from now because the market moves fast. Like, think about that. Try that on for size, okay? Because it's really not making sense a lot of times to tie up your cash for extended periods of time. Okay, thank you for joining me on that video. It was really fun to make. If you want something to watch next, you can learn my entire options strategy and the 7 trades I used to make $400K last year. That was in 2024. With my $600,000 portfolio, and then you can watch a video that I link down in the description, okay? There's also a link down there in the description to book a call with me in case you want to learn way more about my strategy and all of the options trades that I use within my system, and just more of how I implement what we covered on to today. I would love to see you in my course and have you become an options trading master.